2025, 79% of professional fund managers, people who do this for a living, lost to the S&P 500. Not amateurs, professionals, with teams, research budgets, and decades of experience. And that wasn't even unusual. Over 20 years, 92% of them underperformed. So let me ask you something. How many ETFs are in your portfolio right now? If it's more than 5, this video might save you a lot of money and a lot of stress. Today, I'm going to show you the best 3 ETF portfolio for long-term wealth building. 3 funds, that's it. Each one fills a specific role. Together, they cover everything your money needs to grow, compound, and protect itself over decades. But here's the thing. 2 of these picks are ones you've probably heard of. The third, that's the one most people get wrong. And right now, getting it right matters more than it has in over a decade. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, here's what most people don't realize. The biggest threat to your portfolio isn't picking the wrong fund. It's picking too many of them. Every extra ETF you add is another decision point, another thing to monitor, another temptation to tinker when the market dips. And that tinkering is expensive. Studies show the average investor trails the market by over a full percentage point every single year just from behavioral mistakes, selling too early, switching strategies mid-downturn, chasing whatever's hot this quarter. Over 20 or 30 years, that gap can cost you tens of thousands of dollars. Not because you picked bad funds, because you had too many chances to make bad decisions. Smart investors who keep it simple don't fall into that trap. And the simplest system that actually works? 3 slots. A growth engine, a dividend engine, and a global shield. Let me show you how to fill each one. Step 1, your growth engine. And for most long-term investors, the answer is VOO, the Vanguard S&P 500 ETF. One fund, 518 of the largest companies in America. Apple, Microsoft, Nvidia, Amazon, you own all of them. And it costs you 0.03% per year. That's 3 cents for every $100 invested. Basically nothing. Over the last 10 years, VOO has returned roughly 15% per year. Not in a straight line, there were plenty of rough months in there, but over time, the trend has been overwhelmingly up. Now, I know some of you are already thinking it. What about VTI? Fair question. VTI gives you the total U.S. stock market, not just the biggest 500 companies, but also mid-caps and small-caps, about 3,500 holdings. Same expense ratio, same 0.03%. Here's the honest answer. The correlation between VOO and VTI is 0.99. They move almost identically. Over the last decade, VOO has slightly edged VTI because mega-cap companies led the way. The gap is tiny. Pick one, stick with it, don't overthink it. I lean VOO for the tighter focus on large, proven companies, but VTI is a perfectly fine choice. The wrong move is owning both. That's just doubling up on the same exposure. So that's step 1. Your growth engine is locked in. But here's the thing. An engine without fuel eventually runs dry. Step 2 adds something most growth-only investors completely overlook, and it changes everything. Step 2 is your dividend engine. And my pick here is SCHD, the Schwab US Dividend Equity ETF. Now, this isn't about chasing the highest yield you can find. That's actually a trap. Funds with 7 or 8% yields often cut their dividends when things get tough. SCHD doesn't play that game.
Here's what SCHD does instead. It holds about 100 high-quality U.S. companies, firms with at least 10 consecutive years of dividend payments. It screens for return on equity, cash flow, and dividend growth. Every March, it kicks out the weaker names and replaces them with stronger ones. The result? An expense ratio of 0.06%, a current yield around 3.3 to 3.6%. And here's the number that really matters, a 10-year dividend growth rate of roughly 11% per year. Let me think about what that actually means for your money. If SCHD pays you $1 today and dividends keep growing at 11% a year, in about 6.5 years, that dollar becomes 2. In 13 years, it's 4. Your income keeps doubling without you lifting a finger. Now compare that to VYM, Vanguard's high dividend yield ETF. VYM holds about 550 stocks. More diversified, sure, but its yield is lower, around 2.2%. Its dividend growth is slower, roughly 6 to 8% a year. Over a full decade, SCHD returned 229% cumulative versus 201% for VYM. Quality beats quantity. Here's a myth you hear all the time. Dividends are nice, but they don't really move the needle. Here's the truth. Going back to 1960, 85% of the S&P 500's total cumulative return came from reinvested dividends and the compounding that followed. 85%. Most of the wealth the stock market built wasn't from prices going up. It was from dividends being reinvested, quietly, automatically, and compounding year after year. If someone you know invests without dividend reinvestment turned on, they need to hear that number. Send them this video. Quick question before we get to the big reveal. Are you Team VOO or Team VTI for your growth slot? Drop it in the comments. I read every single one. All right, you've got US growth locked in with VOO. You've got US dividends compounding with SCHD. But right now, 100% of your money is in one country. And after what happened in 2025, that's a blind spot you can't afford. The mystery pick is next. Step 3, the question mark revealed, your global shield. Step 3, the one most people get wrong, and the one that might matter more right now than it has in 15 years. The question mark is VXUS, Vanguard Total International Stock ETF. Here's why. The United States makes up about 48 to 50% of the world's total stock market. That means if you only hold VOO and SCHD, you're completely ignoring the other half. For a long time, that seemed fine. U.S. stocks dominated international markets for over a decade. A lot of people stopped thinking about overseas investments entirely. Then 2025 happened. International stocks didn't just keep up, they crushed the U.S. VXUS returned over 32% that year. The total U.S. market, around 17%. That's nearly double the performance. Now, 1 year doesn't make a trend, but here's what the research says. Vanguard's 2026 outlook projects 4.9 to 6.9% annual returns for international stocks over the next decade. For U.S. stocks, just 4 to 5%. BlackRock's numbers tell a similar story. International valuations are cheaper, the dollar has weakened, and global companies are investing heavily in AI and infrastructure. VXUS gives you over 8,500 holdings across more than 40 countries. Developed markets like Japan, the UK, and Germany, emerging markets like India, Taiwan, and Brazil, all for 0.05% per year. Now, I know international is the most debated slot in any portfolio. Some people say U.S. companies already earn revenue overseas, so you don't need international funds. Others say skipping half the world is reckless. I come down firmly on the side of owning it, not because I can predict which market wins next year, nobody can, but because concentration in one country is a risk, not a strategy.
If you want alternatives, VEA covers only developed markets at just 0.03%, cheapest option out there. IQLT screens for quality, strong balance sheets, high return on equity, but it's smaller and more specialized. For most people, VXUS is the cleanest, simplest answer. And simplicity is the whole point of this system. Do you hold international in your portfolio right now? Yes or no? I'm genuinely curious. All right, now you know all three. VOO for growth, SCHD for dividends, VXUS for global protection. But knowing the names isn't enough. The real question is how much of each, and that depends on where you are in life. Build it, your allocation and action plan. Here's where we make this real. If you're in your 30s, you've got time on your side. Lean aggressive. A strong default is 60% VOO, 20% SCHD, 20% VXUS. Growth leads. Dividends compound in the background. International adds the safety net. If you're in your 40s, start shifting the balance. Move to 50% VOO, 25% SCHD, 25% VXUS. Still growth forward, but you're giving dividends and global exposure more room as your timeline gets shorter. And here's the part that matters more than any allocation split. The exact percentage matters way less than consistency. The person who invests $300 a month and never stops will beat the person who agonizes over 55% versus 60% every single time. Now let me walk through the math. And before I show you the 30-year number, take a guess. $300 a month, 30 years, 8% average annual return. What do you think that grows to? Got a number in your head? At 8%, $300 a month becomes roughly $447,000. Bump that return to 10%, which is close to the S&P 500's historical average, and you're looking at about $678,000. Start with $500 a month instead. At 8%, that's roughly $745,000 over 30 years. At 10%, you're past $1 million. That's not magic, that's just math, and it works because you kept the system simple enough to actually stick with for 3 decades. One more thing most people skip, and honestly, it might be the most valuable part. Where you hold these funds matters almost as much as which funds you pick. Put SCHD in your Roth IRA. Those dividends grow and compound completely tax-free. That's your highest yielding fund earning money the IRS never touches. Hold VXUS in a taxable brokerage account. Foreign funds pay foreign taxes on dividends, and in a taxable account, you can claim the foreign tax credit to get some of that back. Inside an IRA, that credit disappears. VOO goes wherever you have room left. It's tax efficient in any account. Then automate your contributions. Turn on DRIP, dividend reinvestment, and rebalance once a year. Just nudge your percentages back to your target allocation. Studies show annual rebalancing performs just as well as monthly with a fraction of the effort. And please, don't wait for a dip. Research from Vanguard shows that investing immediately beats waiting for a better price about 2/3 of the time. Time in the market beats timing the market. That's not a cliche. That's 46 years of data. You don't need 30 ETFs. You need 3 that work and the discipline to let them. That's the whole system. 3 funds, 1 rebalance a year, and decades of compounding doing the heavy lifting for you. If someone you know is still overthinking their portfolio with a dozen different funds, send them this video right now. It might be the most useful thing they watch all year. Now, I want to hear from you. What does your 3 ETF split look like? Or what would you change about this one? Tell me in the comments. I want to see your setup. If you're building long-term wealth and want to stay ahead of smart moves like this, subscribe to this channel and hit that bell so you never miss what's coming next.